All right. I want to welcome everyone to today's webinar. We have special guest, Paul Moore of Wellings Capital. Just a few things first here. Our disclosure, Camaplan does not give any investment advice nor endorse anyone. Everything is for educational purposes. Consult with your CPAs, advisors, and other professionals before making any investment. What is a self-directed IRA? A self-directed IRA lets you invest in anything that you want that the IRS doesn't prohibit, which is a pretty small list, and that's collectibles and life insurance. So as long as it doesn't classify as that, you're able to use an IRA to make an investment. This is what we see the majority of our clients investing in: real estate, and that's all types of real estate.
Paul, did you lose Ryan? Oh, there he is.
Metals, physical, bullion stored at a depository. On the left there, the tax deferred accounts, and on the right are the tax free accounts. You can even combine those and part in those as well. So I'm going to turn this over to Paul here, and he can tell you, but I'm just going to show my information first. If anybody has questions regarding their IRAs, I can be reached at rfischer@camaplan.com. That's Fisher with a C, RFISCHER at camaplan.com. You can also call our phone number, 866-559-4430. I'm going to go back and welcome, Paul. Thanks for being here with us today. Look forward to the information.
Yeah, it's great to be here, and I really appreciate this opportunity. I've spoken to the Camaplan crew before, and it's great to be back again. So thank you, Ryan. Thank you, Rebecca. I will try to share my screen.
Let me bring that back over to you.
Okay, great. Let me know when you got that. And really appreciate, again, this opportunity. Thank you all for taking your time. I know it's lunch for a lot of you. Some of you on the West Coast, it's probably just 9 in the morning. But what a great opportunity to discuss investing in real estate. So do you see my screen okay?
We do.
Awesome. All right. So the question for the day is, why is a multifamily author not investing in apartments right now? And I got to tell you, my wife wasn't real happy with me because I was a shiny object chaser for years, and I deemed myself as a serial entrepreneur. And I thought, hey, I'm going to put serial entrepreneur on my business card.
Hello?
What's that? Can you hear me okay?
Go ahead, Paul.
All right. So I was going to put serial entrepreneur on my business card. And if you look at my bio, you'll see why, because I've done a whole lot of stuff. But my friend was running for governor of Colorado years ago, and he said, you know, we're not so smart. We've done all these different things. It looks like we've chased shiny objects. We've done this kind of real estate, that kind of real estate. We've done self-storage and commercial and residential and all these other things, oil and gas. And the smartest people in the world that he was meeting, the billionaire types, were really, really focused. They were hyper-focused on a few things. And they realized that one thing, if I can become a master of this one thing over decades, I'll do better. So I told my wife years ago, I'm going to stick with multifamily. We had built a multifamily facility in North Dakota about 10 years ago, and we operated that for a number of years. And then I ended up writing a book on multifamily investing, and it had the humble title, The Perfect Investment. And some of you know that. And the book, I told my wife, we're just going to stick with multifamily from here on out. Well, I didn't do that because after a number of years of doing multifamily, we decided that there was a better path. So today I'm going to talk about that. Multifamily has exploded. Almost everybody loves multifamily right now. And again, I have this humble title, The Perfect Investment. I'm going to talk to you today about why I love multifamily, but I'm also going to talk to you about why we expanded into other asset types as well. So the reason I got into multifamily, I was in residential real estate for years. And I thought for years, maybe it would be great to jump up to commercial real estate investing, but I wasn't sure where the on ramp was or how to get involved. Now, if you took this house on the left or a house in that condition and you bought it for $100,000 and you added like $700,000 worth of improvements and you made it look something like the house on the right here, let's say you added, build out the attic and you finished the basement, you put on huge additions and you did everything imaginable and you had $700,000 in it. Well, if it's in a $300,000 neighborhood, I think most of us on the call today know that's not a real sensible strategy because the neighborhood, the comps determine the value. But it's not true in commercial real estate. In commercial real estate, the math determines the value. And if you all are available about a month from now, we're going to do another one of these and we're going to talk about the details behind the powerful math behind commercial real estate and why the wealthiest people in the world, almost all, invest in commercial real estate. Like I said, we'll talk about that next month. You should be able to sign up for that soon. But in the meantime, let's first talk about why multifamily is such a great asset class. Now, in the 90s, the government, in its great wisdom, decided that they thought that everybody who could fog a mirror should own a home. And they began to put laws in place that forced banks and other lenders to loan money to people who probably shouldn't have owned a home. And home ownership skyrocketed. They called it a great success. From 95 to 2006, home ownership went up from about the historical norm of around 63%, 64% perhaps, to 69.2%. But then we all know what happened during the great financial crisis. It took a nosedive and home ownership went back to more of a historical norm. In fact, below that to 63%. And when that happened, about every percentage represents about 1 million people who are entering the renter pool or who are not owning anymore. And so with this historical low of 63% home ownership, you have to ask what, is driving this kind of situation. Of course, we just talked about the government, the foreclosures that happened, but we also can say that in addition to that, there are other things driving this continual trend toward renting. And I will tell you before we go on that another thing I love about multifamily is the delinquency rates are so low. Now, during the great financial crisis, you can see with Freddie and Fannie, that's Freddie Mac and Fannie Mae loans, the single family delinquency rate was very, very high compared to the norm. It was above 4%. Okay. But private banks, local banks, regional banks, you might recall, had delinquency and default rates up to 9 or 10%, double Freddie Mac and Fannie Mae. But this chart shows what happened to multifamily. See the dark line along the bottom? Multifamily only got up to 0.4%. And that includes not just states like Pennsylvania and Virginia, where many of you and I live, but that includes places like Florida, California, Nevada, Arizona, the Sand States, where things were really, really rough. And a lot of single and multifamily went back to the bank. But like I said, multifamily delinquency rate was 90% lower than single family, and it's currently about 98% lower than single family. And in fact, there have been virtually no large multifamily defaults in the last several years from agency debt. That's Freddie Mac and Fannie Mae. And so what's driving this wonderful increase in multifamily? Well, first of all, you've got demographics behind the demand. You've got baby boomers, and that's about 77 million of us, and about 80 million millennials flocking to rental housing. Baby boomers are the second largest demographic group in US history, soon to be the third largest, from what I understand. And the increasing lifespans of baby boomers and the frustration of baby boomers that happened from the great financial crisis are driving increasing rentals. Now, we're the smallest group of renters demographically in the US, but the fastest growing. And statistics say when baby boomers begin to rent, they will never go back to home ownership again. Now, millennials are also renting. In fact, millennials on average have high student debt, high credit card debt, not a huge penchant for savings. And many of them, not all, but many of them reason, why should I get tied down to a 30-year contract on a home when I might have new friends, new jobs, new opportunities across the city or across the nation next year? And so a large percentage of millennials have been renting. They like being close to public transportation. They like not having to deal with the repairs. They like the flexible lifestyle. And so, as of the time of this statistic, at least 54% are renting, where historically the number has been closer to 30%. Now, immigration is playing a big role in the US population as well. And you can see that the immigration numbers, the part in the mustard yellow there, is increasing every year in the US and the population. And so people who were not born in the US generally rent more and rent for longer than those who were born in the US. Now, we've got another demographic group that's not listed here, and that's Gen Z. It's really hard to tell where they're going to land. Some people say that they're going to be owning more. Most people say that they're going to be renting perhaps even more than millennials. And so that's the folks who are about 24 years and under right now. And of course, as you can guess by their age, they're generally renting at the moment. So the question of the day is, why is a multifamily author not investing in multifamily right now? Well, there's a couple answers here. So first of all, you've got these great demographics, these low default rates, and the fact that it's recession resistant. You've also, but you've got the situation also that the space is significantly overheated. Cap rates are at a record low. And when I say cap rates are low, that means the rate of return from multifamily, the expected rate of return is at an all-time record low, which means, of course, the converse is true, it's that prices are at a record high. So what's driving this? Well, first of all, you've got a lot of 1031 exchanges. And for those of you who are involved in real estate, you realize that is people who are selling an asset at the top of the market, and they're often buying above market price. They're paying above market prices for multifamily. Multifamily is so popular that a lot of people are overpaying. Now, another group that is investing heavily in multifamily, and I'm one of them, is IRA investors. And that's what a lot of us are here. Now, we don't want to see anybody overpay, but for some reason, we've seen, just this increase, this explosion, if you will, in self-directed IRA investors, which is a great thing. And we hope that all of you who have IRAs with Camo Plan are going to invest in real estate. But that influx of cash, sort of like we saw from 401ks and such in the 80s and 90s, is causing an increase in valuations of multifamily and other asset types. We've got international money coming in at a record pace. It's so easy to invest in the US right now. I mean, somebody in India or China, different places can click a link and invest in the US. It's easier than it was before. Institutional money's coming in at a record pace. Institutionals like life insurance companies and other, REITs, et cetera, love multifamily and other commercial asset classes. We've also got tax reform. And the tax reform that was passed in December 2017 has added fuel to an already overheated fire. Now, some negative things that have happened are the Nuru impact. The Nuru impact is something that I'm trying to coin this term, and I'm hoping you'll all help me make it more popular. These are people who are gurus, but they're new at it, meaning that they weren't even involved in multifamily. They might not have even known what it was during the Great Recession 10 or 11 years ago, but now they're teaching others. There's no problem with them being involved. That's not a problem at all. But when they're teaching others and telling them things that aren't necessarily true, that can be problematic. In fact, some of these new rules are actually wolves in sheep's clothing. I was actually in Miami, Florida at a conference, and a guy came on stage who was a multifamily guru. And he said, it doesn't matter what you have to pay for a multifamily. It just goes up and up and up. It'll never go down. Just pay whatever you have to get in. You'll be glad. And I literally thought that he was making a joke. And this guy was really famous. And I thought, oh, certainly he's going to tell a punchline here that that's not true. But he wasn't joking. And that's just not good thinking. I mean, Warren Buffett, Charlie Munger, Howard Marks, some of my investing heroes, they have the opposite opinion. They're going to say, the rising tide raises all boats, but eventually the tide's going to go out. And then we'll see who's skinny dipping. Well, we don't want any of you to do that. And that's one of the reasons we're here doing this type of education today. Now, one of the big issues and the reason I'm not investing in multifamily at the moment is that such a consolidated asset type. There is multifamily is well established. The 70s and 80s and early 90s multifamily have already had lots of upgrades. The owners are professionals. They're not typically mom and pops. And because of that, the owners of these large apartments have already done the upgrades. They've already wrung the value adds out of these properties. And as a result, it's very hard to find a good deal with a lot of upside now. Now, check out this graphic. On the right, we've got multifamily ownership, and I should have put this in the notes. This is for 50 units and above. Now, it's said here that 50 units and above, 93% of multifamily are owned by corporations. In other words, they're owned by companies that own multiple apartments, and only 7% are owned by individuals or small owners. But check out the middle here, mobile home park ownership. 90%, it's believed that about 90% of the 45,000 or so mobile home parks in the US are owned by mom and pop operators. These are people who are older. Often they don't have the desire or the resources or the knowledge to upgrade and maximize value, and therefore maximize the the income and the resale value. Self-storage, kind of similar. About 76% of the operators are independents, and that doesn't mean they're doing a bad job, but it means that they might not be doing everything possible to increase value and to maximize their shareholder returns. Because again, an independent operator might have had this property since the 80s. They might have they might be older, they might be enjoying life, they might be, they might live in Myrtle Beach while the property is in Louisville. And so they are not able to maximize value, and they don't really care because they're making a good income from this. And so the mom and pop opportunity is a really big deal. For self-storage, it might mean that they're not online. They don't do online marketing. They don't even have a website. I talked to a self-storage owner near Raleigh, North Carolina, great location on a main road. I said, do you have a website? She said, I don't have to. I stay full. Well, if you stay full, you're probably, especially without internet marketing, you're probably undercharging. And there's an opportunity for a new owner to come in and raise rates there and actually make a nicer facility. Typically they're not super well run. There's not online options. There's no There's limited hours for access. And the net effect of this is just missed opportunities. And so the cool thing about this is, as an investor in the space, we can pay a mobile home park or self-storage mom and pop operator top dollar in their mind for their property. And when I say in their mind, I'm not trying to play games here. I'm saying they never dreamed that they would get as much as we're willing to pay them. But there's still a lot of meat left on the bones. And that's the bottom line of why I am kind of holding back on multifamily investments right now. It's very hard to find something with upgrade potential. And so we're expanding into asset types that are also recession resistant, like apartments are, but they have a lot of upside potential. Self storage on the left and mobile home parks on the right. These are both assets that we have invested in the last several years in Wellings Capital. So this screen's going to be a mouthful. I'll just go through some of these. The self storage is recession resistant, but they're strengthened during economic booms. If you think about it, when people are downsizing, maybe going from a 4,000 to a 2,000 square foot home, or a 2,000 square foot home to an apartment, in bad times, they need a place to store their stuff. In good times, they're filling up their Walmart or Amazon carts and they're looking for a place to store their stuff. There's also baby boomers who are losing parents like I did and need a place to store their stuff while we go through it. And there's online businesses, there's all kinds of reasons self-storage has been booming. Um, the tenants are not particularly price sensitive either. I mean, if I have $1,000 apartment and I get a rent raise of 6%, if I sign that lease, I'm signing up for $60 a month or $720 a year. But if I'm paying 100 for a self-storage unit and I get a 6% raise, well, that's only $6 a month, and I'm only a month to month anyway. I figure, I'm not going to be here that long anyway, and I will sign that increase and pay that extra $6 a month rather than get a U-Haul, get my friends together and move all my junk, my treasures down the street to save $6 a month when they could raise it as well. So fragmentation, we already talked about that. There's a very, very small number of professional operators relative to the number of total facilities. There are 53,000 self-storage facilities in the US. That's about the same as all the Subway, McDonald's, and Starbucks combined. So it's a large industry, and there's a perception that they're easy to run. I get emails like this. They seem real easy to run. Well, it is easy to run a mediocre facility, but it's hard to manage a great one. And that's the kind of investments we're looking for. We're looking to take mediocre facilities and make them great. So there really is a powerful business plan to upgrade and then eventually sell to an institutional buyer. It's possible to reconfigure the units to meet demand. You can change the sizes. It's cost prohibitive in great locations for new buyers to come in and build. And the value adds are often really low cost. Let me give you an example of one. If you add U-Haul to a self-storage facility, you can add $3,000 to $5,000 a month. I should say up to $3,000 to $5,000 a month. And so let's say you add $3,000 a month to your income, and that's just from commissions on U-Haul. That's $36,000 a year. And if your cap rate, if your rate of return is 6%, and like I said, we're going to get into the math on this next month, but that's a $600,000 potential increase in value at your property just from signing a U-Haul agreement. Well, if you're in the right place, you can even make more than $3,000 a month. So it's quite a big jump in value. Mom and pop operators I've talked to say that's too much hassle. And it probably is hassle. But like I said, it's hard to manage a great facility, but it can be really well worth it. These are the returns in self-storage of REITs over the years from 1994 to 2017. The average annual return in self-storage has been higher than these other asset types. And like I said earlier, a great business plan is building a portfolio, making that all similar and unified, and then selling the whole portfolio to a larger buyer. A lot of these REITs and institutional buyers really like to write, let's say, $50 million checks. Well, it's really hard to find an individual self-storage or mobile home park that's 50 million. There's a few in the US, but if they want to buy, they're going to generally be buying portfolios, and they'll pay more per capita, if you will, for a portfolio than an individual property. So it's a great business strategy to put these together. And this is the kind of the realm that we're currently investing in. So I told you why I love self-storage. I'm also going to talk to you about why I love manufactured housing communities, which is a fancy word for mobile home parks. Now, these are recession resistant. I mean, even more than self-storage. They're steady in all cycles. People don't like to move out of mobile home parks because when they do, they have to leave their home behind. And they usually can't sell it for what they've got in it because it's a declining value asset. And so they're really recession resistant. In fact, in bad times, people are downgrading and they end up in a mobile home park. Sometimes that's their last stop before they end up under a bridge. It's the only asset class that I know of that has an increasing demand and a decreasing supply every year. It's because of NIMBYism in part. NIMBYism is not in my backyardism, which means they don't want to build a new, most cities and counties don't want a new mobile home park. That's why you rarely see one going up. There's other economic reasons as well that make them hard to build, but it's the only asset type that I know of that has an increasing demand and a shrinking supply every year. There really is an affordable housing crisis. It's believed that about 10,000 people a day turn 65. And 6 out of every 10 of those, 6,000 out of 10,000, in other words, have less than $10,000 saved for retirement. And that's why it's really important that you all get with Cama Plan and get your self-directed IRA fired up and funded and make sure that you are not in that situation. But honestly, if all these people have less than 10,000 saved for retirement, but a lot of them have home equity, many of them are willing to trade it in on a mobile home park lifestyle. And we've seen that over and over. The very high switching costs. I mean, if somebody gets a $40 increase on their bill, let's say they're paying $400 a month and all the other parks in the area are at $500, and they go up from $400 to $440, that's a pretty big increase, 10%. But it's a lot cheaper than moving the mobile home down the street, spending $5,000 just to save 40 bucks a month. And they're not going to do that if everybody else is even a higher level, a higher rate. And so that's typically the situation when we buy from a mom and pop. And we told you about that fragmentation issue already. We also love the fact that there's low maintenance and predictable capital expenses at a mobile home park because unlike apartments, we had a $107,000 water main break under an apartment building a couple years ago in an apartment that my company owned. Very, very painful. Mobile home parks, on the other hand, typically don't have large buildings that they own. I mean, they might have the clubhouse or the office, but they're not going to, typically have the same level of capital expenses and maintenance that other asset types have. And we love that because the best mobile home parks are actually just leasing land. Now, there is a stigma of mobile homes. People think, oh, I don't want to invest in mobile homes or mobile home parks. That stigma has actually kept the industry being one of the best kept secrets, if you will. And Sam Zell, the largest and most successful real estate investor in America, possibly the world, has taken incredible advantage of the stigma over the years. And he got in. He's got 157,000 mobile home park pads in total in the US, and he's done quite well for himself. Now, this is a hard to understand graphic, and it would probably take me 5 minutes to explain it. But the bottom line is the goal is you want a star as high as possible on these graphs, and that's the square feet. And then you want the bar as low as possible, and that's the average monthly rent. And so the average monthly rent for a manufactured home where the lot or the house is owned by the individual, which is typical, is 350. But the average square footage is much higher than the next level up here, which is the apartment, which has a much, much higher rent, but a lower size. And then single family rentals are on the right with the highest cost and the highest square footage. One thing people love about mobile homes is they can typically get a 3-bedroom mobile home with a yard, with parking right by the front yard, and not, a neighbor right through a paper thin wall for much less than a 2-bedroom apartment. And this graphic explains that. I mean, in my state of Virginia, it's almost 3 times as much on average to get a 2-bedroom apartment as it is to get a mobile home with 3 bedrooms. And of course, that's just the lot rent. But the point is, typically they own their mobile home anyway. Another thing I mentioned earlier was the CapEx. The capital expense on manufactured housing is the lowest of all these asset types. Parking and self-storage are right behind it. Multifamily on the left here, wow, it is like 3 or 4 times higher. And believe me, I have felt the pain of that. I also mentioned non-existent supply of new parks. And our friends at Seneca gave us this graphic. That's why it's in their colors here. Look at that, 0% increase in net increase in manufactured housing spots in the US. But look at apartments, much higher, industrial and office even higher. And so this is, a really, really important graphic to me because again, it shows that mobile home parks are just not increasing to meet the demand. Before we wrap up here, I do want to say that mobile home parks do have this stigma. I mean, we think of mobile home parks like the one on the right. That's the kind of thing we would love to invest in, not the one on the left. The one on the left there, that looks like a place next door to where my family vacationed as a kid. And that's what a lot of us think of when we think of mobile homes and mobile home parks. But that's not really the case with what we're talking about investing in here. This graphic shows that self-storage and mobile home parks did very well in general since the great financial crisis. But I think what I want to point out here is mobile homes, the top line here, they had no dip during 2008 through 11. I've talked to mobile home park owners during that time. They didn't have a dip in general in their economics. And so we really do believe they're going to be recession resistant regardless of what happens here in the near future. The returns on mobile home parks and self-storage are higher on average than these other asset types. Manufactured homes by far the highest here, and then healthcare and self-storage tied for second place. So before we wrap up, I just want to show you a couple photos here. These are some assets we invested in. This is a self-storage facility in Aurora, Colorado, near Denver. And I was out there in Denver last week. This is a manufactured home community south of Columbus, Ohio, that we invested in last year. This is another one in Gillette, Wyoming, we invested in. And this is a self-storage facility in Austin, Texas. And it almost at first glance looks like an artist's rendition, but it really is a beautiful photo of a self-storage facility that we are glad that we invested in. I want to make one final comment. A lot of people are saying these days, we really, that mobile home park owners or apartment owners are the bad guys. We're always hurting people. I would say it's quite the opposite. And there's a lot of statistics to show this. Mobile home park owners are providing an incredible home and a place to grow up for families like this one. This is a family in Texarkana, Texas, and they had just purchased this mobile home right before this photo, and they were really happy, and they brought the owner back to the home to let them take photos. And the point I'm making here is, if we're providing an alternative for this family so this lady doesn't have to work 2 or 3 jobs, so she can start putting money aside for her kids for college, it's a great thing. It's a great feeling to be a mobile home park owner, but we also have a responsibility. We're responsible not to gouge these people. If we could, it's important that we don't. And that's the kind of people we want to invest with, people who are actually putting their tenants first, taking care of them, making a nice, cleaner, safer, drug-free community for their residents. And I'd recommend that if you get involved, that you consider looking for opportunities like that as well. If you want to reach out to me, you can schedule a call here, or you can also get an e-course or an audio course on commercial investing at this website. And we also have free special reports on mobile home park and self-storage investing by visiting wellingscapital.com/resources. And you can email us at info@wellingscapital.com. Like I said, we're going to do another webinar next month. I'm really excited about it. It's how to invest like the Forbes 400, why the world's wealthiest almost always invest in commercial real estate. So with that said, I am going to turn this back over to Ryan and Rebecca, and hopefully we'll have a few more minutes left here for Q&A.
You can leave your screen up there.
Okay.
Paul. I did want to let everybody else know that they can also put questions in the chat, but I do have one here.
Okay.
And it says, Paul, are camper sites treated the same for numbers like MHPs? Mobile house.
Yeah. Great question. So are camper sites considered the same? So generally camper sites would be considered RV parks. And so we invest with one company based in California that does mobile home parks and RV sites. And the math is the same. But even though the math is the same, which we'll get into next month, like I said, the actual business is a little different. During COVID, mobile home parks did really, really well, Ryan. But RV parks had some really, really difficult times there. Now it's interesting. RVs have had I didn't see I didn't see the actual source for this, but from what I understand, Ryan, the RV industry has had a 700% increase since COVID. And you guys can imagine that people are buying motorcycles, people are buying they're buying all kinds of things right now to to enjoy life with their family and to beat COVID. And RV parks are doing really, really well again right now. I hope that helps answer the question. What other questions do y'all have?
Yes, we will have we will. Somebody just asked. Others did ask too for a copy of your presentation, which you can send them or we can send them. And then, yeah, the recording will be on our website usually within a week of this. So you should be able to find it under CAMA Academy and then recorded webinars.
All right, great.
Well, thanks, Paul. I appreciate the information. This was great, and look forward to what you have to tell us next month. I think everyone should, if you like this information, you'll probably want to join in and see what Paul has to say next month. Our calendar can be found on our website as well under CAMA Academy. If you have any questions, you can get to me through camaplan.com. And thanks again, Paul. We really appreciate having you here today.
Absolutely. And I've got a couple questions coming in on the Q&A here, so I'm going to try to stay and answer those. But Julia specifically, if you want to reach out to me, you can reach out. And I see I'm actually sharing that with the whole group there. Sorry. But you can reach out, Julia, and I'll be glad to answer your questions. All right.
All right. Thanks again, Paul.
All right. Thank you.
Good rest of the day, everybody.
All right.
Thank you.
Take care.
Bye.
All right. Ryan, you still there? Rebecca?
Are we all finished?
Yeah, I think so.
Well, thanks so much, Paul, for speaking and going over this information with us today.